Three finance heavyweights have been openly warning about the credit market and say that they are getting deja vu. Dani Moses from The Big Short believes the private credit push into retail products reminds him of the beginning of the 2008 crash. Jamie Dimon, who loves to warn about the industry, says that he's seeing parallels to the financial crisis. Boaz Weinstein saying the wheels are coming off for private credit. Let's discuss with TKO Capital co-founder Mathieu Chabran. His firm oversees more than $60 billion, about 46 of which is in private debt. No one else we'd want to talk with right now. Mathieu, thank you so much for joining. The concerns, the angst, what have you, how much of it is actually real at this point?
Well, I mean, it's real because, you know, when you're investing in credit, there is some risk that you need to underwrite. And I think that people had lost sight that there could be effectively some work to be done in credit. So, you know, it's great to see this movement, you know, in the market. And I think it comes down to the fundamental of credit, which is, are you financing cash flow? Do you have an asset coverage? And all of a sudden, people, you know, wake up to the fact that effectively, over the past few years, some may have used credit as a proxy to equity, and when you're financing, you know, some ARR-based company, you know, that's you must wake up at some point, you know, to this credit cycle. So overall, you know, yes, there's some action taking place in the market, but for the better, you know.
If I were to look out at this dispersion, because there always is this thing of maybe it's less transparent, so it's hard to find. If I'm to look out and say, where have the mistakes been made? What would I look for?
Well, I mean, the first of all, you know, in my view, is when you started having an asset-liability mismatch. And this huge development in the private market of this open-ended fund, semi-liquid fund, you know, pushed to retail, by the way, sometimes, effectively when people realize that they want out, you know, you've got this mismatch. I mean, we're not trading QSIP-based securities. You know, those are private assets. We saw that a couple of years ago, you know, on the real estate side, you know, and you remember the headlines there. So now it's coming to credit. So I think it's the right asset with the wrong structure. I think there is a silver lining there for sure, in my view, which is you can still use this type of structure, but by not promising, you know, some outperforming return, you know, not having, you know, so much leverage in the system, and coming back to the basics of, you know, asset underwriting.
Yeah, I mean, to me, Boaz Weinstein really captured it when he said, the problem is they convinced investors that this was the greatest invention since the internet, private credit, right? When it really was just lending money to small companies. Yeah. So how do you see the wheels on the car? Are they coming off? Yeah. Is it that bad? Or is this just the kind of blip that, you know, Mark Lipschultz says they've been through before? Yeah, well, you know, if I may, the people, you know, saying that is that they want to take the opportunity to park their garbage truck, you know, and try to fill in, you know, with everything they could.
Which, by the way, Boaz Weinstein, of course, did buy some of what was sold off from Blue Owl.
And he wants to take, I mean, he has really taken the gloves off, that guy.
No, but I mean, listen, as you were saying, you know, Dani, the secondary private credit, that is a new asset class, you know, in itself. I mean, you know what happened to the private equity secondaries that has grown over the past 20 years. I mean, now that the golden age of this new asset class, you know, for sure, because you're going to be providing liquidity to an illiquid asset class otherwise, but with the right, you know, with the right structure. I mean, you guys here at the BDCs, right? The BDC market is nothing else than effectively a private credit fund, which is supposed to address its liquidity on its own, you know, through the market. And effectively right now, those BDCs are trading at a discount, you know, they're generating a double-digit yield, and that's a great data point, you know, to reset the market.
So, and of course, we should mention you just raised a very large secondary private credit fund, $1 billion. So, you know, you hear stories of Blue Owl is selling some of their BDC exposure. New Mountain Capital, what does it actually look out there? Is there a fire sale happening on right now?
Actually, you know, the private market are not reacting as aggressively maybe at the public market, if looking at the stock, you know, at the stock price. The processes are still, you know, they're still orderly, you know, in an orderly, you know, manner for sure. The price discovery here, I mean, you have to do the work, and the numbers, you know, that some of the people externalize, you know, where they sold effectively their private credit asset is actually not that distressed. You know, people are expecting for some distress. I think it's certainly too early because yes,
maybe they're their best assets, Mathieu. I mean, you're right that Blue Owl said I think they got 99.7%. Yeah. New Mountain got what, 94%? Yeah. So the numbers are getting lower, but are they selling their best assets to get those high numbers?
Sell the best and keep the rest, right? So, but no, I mean, our practice, if I talk about TKO, for the past 5 years we've been active there, our average price was 85 cents a dollar. Because effectively, there is a illiquidity premium that you need to crystallize for your investors. And so I don't think that those good assets are going. I think the nature of the buyer, and if you look at the nature of the buyers who provided liquidity in these circumstances, are people who might have different type of capital, in terms of expected return, in terms of flexibility, in terms of liquidity. So I think it's just a normal process that is starting. Yeah.
Well, the buyer also, in some cases, is the insurance companies that they own.
Well, how do you? Is that a problem?
No, I mean, I cannot comment. I'm not involved in this transaction.
Well, what about? Okay, so part of Jamie Dimon, and of course I caveated it by saying he loves to be there's a problem in private credit, but he talked about this time that maybe the 2008 moment gets caused by software exposure. It feels to be like the original sin in the public market's minds of what's happening with private credit. What is your software exposure like? How are you thinking about this as an asset class? Is there concern? Is it all going to be okay?
Yeah. Well, I mean, we went public, with that last week when we reported our earnings. Our software exposure is 7%, which is way inside, the 20% of the market, if not higher, once you retreat the industry services, or others. So I don't know if private credit is the best invention, since the internet, Matt, but probably AI is, right? And so that's where people wake up, to this big theme around, but not everything will go to zero, otherwise we'll have a serious, issue on the market, and that's our take. For sure, yeah.
All right, so it is a fascinating time to be buying up these assets, and you're saying it's a new asset class, but it's really just you're bargain hunting, right? With the secondaries fund I'm talking about. It's kind of like what Howard Marks does, or
no, I think it's different because instead of going to one single asset, if you're referring to Oaktree, great investors, what we're doing here, we're providing liquidity to LPs in their commitment, into other GPs. Very similar to secondary private equity. The big difference in credit is that you've got a maturity, a coupon, and a nominal. So you know exactly, what you're, walking away from, unlike private equity. When you look at the development of the secondary PE market over the past 20 years, which is now a proper, asset class, and many, look at what, callers sold themselves, a couple of weeks ago, to EQT. I mean, it's a proper, asset class. Secondary private credit is in the early days because we're just coming out, of this very solid primary cycle over the past 10, 15 years. What's happening right now in the market is a great, wake-up call for some, and this asset class is going to get organized. And so we've been acting there, for the past 5 years. It's not bargain hunting; it's effectively providing liquidity to some people looking at rebalancing their portfolio, change in regulation somewhere.
Exactly. I think of secondaries in private equity, and I don't know this market nearly as well as Dani or you. I think of it sort of as passing the hot potato, right? We can't find any other exit, so let's create another fund that is the exit. In this case, though, you're buying hopefully not distressed assets, but buying assets from a maybe distressed buyer.
Well, actually, you would be surprised.
Distressed seller.
I mean, that's not the case. I mean, today the people who are selling are public pension funds, insurance companies, sometimes family offices with a change of your leadership, and it's a rebalancing of portfolio. I mean, remember that to your point about this big primary market tailwinds, to private credit. Now people are rebalancing their portfolio. That happened, and that started, by the way, when the interest rate started raising, 5 years ago. When we came out of the zero interest rate, policy. That's when the asset class effectively started developing, and we took advantage, of this opportunity. Others have since then. People who thought originally was just a cyclical, COVID-like, people were freaking out, end of the world, and now it has become, really structural. And I think we're only in the early days. There are many people who now, are tackling, this opportunity, but you need to externalize, some track record there. That's where the good managers will make a difference.
Mathieu, it's so wonderful to have a sane voice in what otherwise feels like a crazed market. Thank you so much for joining us. Please come again soon, Mathieu Chabran, the TKO co-founder.